Hello everybody, today we're going to start with corporate finance CFA level 1. It's one of the easiest subjects you'll face when you're studying. I'll start with the capital budgeting. I hope we're going to continue all the other subjects. So what's capital budgeting? Let's start. Capital budgeting is a process of analyzing which projects should be undertaken, as you see here. So which project should I undertake? The project which I should undertake is the project that will maximize firm value. That's the most important thing. The importance of capital budgeting lies in the fact that projects are long-term in nature. So most of projects say 5 years, 10 years or more. So in order to have a capital budgeting decision, you should be very wise and maximize your firm value, and to know that it's very difficult to reverse that decision without bearing high costs. In addition, capital budgeting techniques are very useful in other corporate finance decisions such as leasing, merger and acquisitions, and bond issuance. So, what's the capital budgeting process? How it works? It starts with generating ideas. So, you have investment ideas. It came from within or outside your company. Ideas can also come from different levels of your company, whether high levels, low levels. So it's come from all over the company, even outside the company. So the second step in capital budgeting process is analyzing individual proposals. What does that mean? It means that involve all and gather all information to forecast the project's cash flows and evaluate its profitability, whether these projects are profitable to you or not. Third step is planning capital budget. This step includes organizing profitable projects. Here we will categorize and organize our profitable projects and fit them to the company overall strategy. So these projects will fit to our overall strategy or not. After that, you plan. Planning involves considering time and projects and prioritize projects. So say we have 10 to 12 projects and their ideas. So we start to prioritize the project according to the importance and our resources available to do and make that project or not. The last step is monitoring and post auditing. What does this step involves? It involves comparing actual results with expected or planned results and making appropriate corrective actions for any deviations. In addition to that, monitoring existing projects. If you have still an existing project, we have to keep monitoring it because it helps to set realistic future expectations, not just an expectation from. Be realistic. You may put expectations, but it should be realistic in order to achieve. Okay, and it also monitoring your projects. It helps you to generate new ideas for other projects. So what's the other steps? In capital projects, you have to categorize your capital projects. How we categorize it? So first of all, we have replacement projects. It's low risk projects. You just replace, say you have an old machine, you replace it with a new machine. That's a very simple project. It's low risk. Okay. The second one is expansion projects. It involves the size of the existing project. You increase it. You increase the size of existing product lines. Say you have 3 product lines, we'll make it 4 or 5. This project is more risky than the replacement projects, and by their nature involve more uncertainties than the replacement project. Okay. The third One is new products and services. It's higher risk than expansion and replacement, of course, and exposed to additional uncertainties. It's a new product. We are going to produce a new product. We sure for sure we make all our surveys, we do our feasibility study, but it's still a new product. We wait for the market's response. The fourth one is regulatory safety and environmental projects. What is that? Say you have a factory, a new law, you have to commit with it. Say you have to pollution, any environmental pollution, new regulations. You have to deal with it. You have to adapt with it. If you didn't make the regulatory safety options that are new, you're not going to continue operation. So it's very important. You might quit if the new law is very costly to you to implement it. You may be quit out of the market overall. So I see it's very risky, and it may include two extremely high costs. Okay, where say if you have a factory, you may abandon one of your product lines because the cost of the safety or environmental will be too high, so you might abandon one of the product lines. So what's other projects? Other projects example include research and development expenditure or buying a new executive aircraft. It's not that important. So the first four are very important. I think if a question on the exam in this part, it might be on that part. The next tutorial I'll be explaining basic principles of capital budgeting and assumptions. Have a good day. Bye bye.